Hey everyone, and welcome to today's Explainer. As of August 2026, the financial market is just absolutely flooded. We are swimming in this overwhelming array of highly complex products, aggressive media headlines, and quite frankly, endless opinions on where you should be putting your money. But today, we're going to cut right through all of that static. We are going to uncover the proven, truly data-backed approach to building wealth. We're going to look really closely at what the numbers actually say about our behavior as investors, the hidden costs of all those trendy financial products, and how you can position yourself for long-term success.
Okay, let's dive into this. Here is our roadmap for today. First, the explosion of ETFs. Second, the investor behavior gap. Third, the cost of complexity. And finally, number 4, how to get rich slowly.
Section 1. The explosion of ETFs. Too many choices.
So the financial landscape has expanded at just a breathtaking pace lately. And it really forces us to ask this core question: is more choice actually better for your portfolio? It's kind of the great paradox of the modern investment landscape, right? We're always told that having more options is a good thing. But in the financial world, an absolute abundance of highly specialized choices can sometimes be exactly the thing that completely derails a well-thought-out plan.
Just to give you an idea of the sheer scale of this expansion, over 1,100 new exchange-traded funds, or ETFs, launched last year alone. That is a massive, record-breaking number. Think about that for a second. For everyday investors who are just trying to plan for retirement or maybe save up for a house, this staggering volume creates a literal tidal wave of information overload. Honestly, it is no wonder people get totally paralyzed by choice.
And well, when we actually break down those 1,100 new launches, a pretty concerning trend emerges. Nearly a third of these new ETFs are officially classified as trading tools. So these are definitely not your standard, diversified, set-it-and-forget-it investments. They are highly specific, often incredibly risky products aimed at providing leveraged or inverse exposure to the short-term returns of an index or a single stock or even cryptocurrency. They're built for speculation, not for long-term wealth building, and they introduce these incredibly narrow risks straight into the market.
Section 2. The investor behavior gap. The cost of timing.
That massive explosion of complex choices we just talked about, it leads directly into a massive behavioral trap. We call this the investor return gap. Simply put, this is the difference between a fund's total reported return and the actual return the investor takes home. So why is there a difference at all? It all comes down to poorly timed purchases and sales. You see, investor behavior, things like panic selling during a scary market dip or giving into FOMO and buying at the absolute peak of a bull market, that behavior often has a far greater impact on your financial future than the actual investments themselves.
Now, what's really interesting about this data is exactly how much this behavior costs us. According to Morningstar's Mind the Gap survey, looking at the 10 years ending December 31st, 2025, the funds themselves generated an aggregate annual return of 9.9%, but the actual return the average investor took home, just 8.7%. That is a 1.2% gap purely caused by the timing and magnitude of investors jumping in and out of these funds.
I mean, sure, a 1.2% gap might sound small, kind of like a rounding error. But when you apply that across all U.S. mutual fund and ETF investors over a decade, it translates to a staggering $3.8 trillion in missed gains. $3.8 trillion of wealth simply evaporated. Why? Because investors tried to chase performance and time the market rather than just buying and holding.
And if you want the absolute poster child for this, just look at the recent data on crypto ETFs. Since they launched, the aggregate total return of these funds was actually positive, yet the average dollar return for investors was negative. No way, right? Let me say that again. The funds actually made money, but the average investor lost money. How does that happen? Because investors poured cash in at the absolute peak of the hype right before a massive slump and then likely panic sold when things dropped. This bad timing completely ruined the returns of otherwise positive funds, resulting in a massive, unbelievable 14% investor return gap.
Section 3. The cost of complexity. High fees, low value.
So the crucial point here is that Wall Street absolutely loves complex products, mostly because complexity allows them to charge you higher fees. But chasing that complex, actively managed performance is generally a total fool's errand. Just look at the data from the S&P year-end 2025 persistence scorecard. Out of 505 top-performing, top-quartile active stock funds in 2021, exactly 0 of them remained in the top quartile by 2024 or 2025. Not a single one. As the saying goes, the Fund Manager Hall of Fame is basically an empty room. The winners change every single year, and yesterday's star manager is very often tomorrow's underperformer.
Let's look at another highly complex product that's been gaining a lot of traction lately: buffer ETFs. These funds use options to engineer a defined outcome. They limit your downside risk, your losses, but to pay for that protection, they completely cap your upside potential. Take a look at a typical December buffer ETF spanning 2022 to 2023. It offered protection against the first 9.15% of market losses, sure, but it rigidly capped your maximum potential return at 22.25%.
Now, while these products might work exactly as they are designed to on a technical level, they come with significant trade-offs. As Morningstar's Jeff Tack notes, buffer ETFs aren't cheap. If you want the assurance of a defined outcome, you'll have to pay up for it. You are giving up potential upside during really great market years, you aren't collecting dividends in many cases, and you are paying significantly higher management fees for the privilege.
Just look at the fee contrast here. The average buffer ETF charges an expense ratio of around 0.80%. Compare that to a simple Vanguard Balanced Index Fund, which holds both stocks and bonds, that charges just 0.18%. You really got to ask yourself, are you paying a massive premium just for the illusion of control? Because much cheaper, historically reliable, balanced index funds are readily available to manage your downside risk completely without the heavy price tag of all that financial engineering.
Section 4. How to get rich slowly. A proven antidote.
All right, let's move to and see how this builds a better strategy. Because if complex, high-fee products and market timing don't work, what actually does? Let's walk through the proven playbook for building a rock-solid foundation for your financial future. First up, get a written financial plan that really factors in your specific risk tolerance and goals. Second, simplify. Use broad, low-cost global index funds rather than trying to bet on individual stocks or super narrow sectors. Third, automate your investing. Use vehicles like target date funds that automatically rebalance everything for you. Seriously, mechanize, 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 because automating completely removes the friction and the emotional errors that cause that multi-trillion-dollar return gap we just talked about. Fourth, completely shun all forms of market timing. Just don't do it. And finally, live below your means and save consistently.
And you know, a really crucial part of making this strategy work is just maintaining optimism. I love how financial writer Ben Carlson puts it. He says, "My baseline assumption is that corporations will innovate and look for ways to increase profits. The economy will grow. In the long run, we will see progress." Optimism isn't just fluffy, feel-good mindset stuff. It is a mathematically sound investment strategy. Because at the end of the day, corporate earnings and relentless human innovation are the ultimate undeniable drivers of long-term stock prices.
And this brilliantly illustrates exactly what we mean by human progress. Back in 1932, Boeing built the very first modern airliner. By 1933, there were only 75 commercial planes built in total. Now, fast forward to July 23, 2026. On that single day, over 153,000 commercial flights were tracked globally. I mean, that is just an astonishing trajectory of economic expansion. When you buy and hold a globally diversified index fund, the stock market is basically just the mechanism that allows you, the everyday investor, to profit directly from this exact kind of breathtaking human progress and long-term economic growth.
So, I'm going to leave you with this provocative final thought. Will your portfolio be driven by market noise or a long-term plan? The financial industry is absolutely going to keep churning out thousands of shiny new ETFs every year, and the media will definitely keep generating panic-inducing headlines. But your success? That's going to come down to whether you can tune out that noise, avoid the illusion of complexity, and stick to a simple, automated, genuinely optimistic path to wealth. Thank you so much for joining me for this explainer, and until next time, stay focused on the long view.